Hello sector watchers, welcome to the show. This is the 86th episode of Sector Spotlight for Tuesday the 29th of June, recording it on the 28th. My name is Julius the Kempenaer and I'm hosting this show today as usual from Amsterdam in the Netherlands. It is a full show, so I'm not going to spend a lot of time introducing everything. I just want to tell you that it is the last Tuesday of the month. Regulars will know that we're going to look at seasonality, and that's going to take up a long part of the show. I've already recorded that, so I'm trying to squeeze in right now my introduction and my overview, and I've got about 6-7 minutes to do that. And the remainder of the show will be dedicated to seasonality and another variation of visualizing that seasonality, those 3D charts that you're used to. We're going to look at a slightly different way of using that. So without further ado, let's start with a quick overview of asset class rotation that we saw last week. On the screen, the RRGs daily and weekly for the various asset classes. Really quickly on the daily RRG, good week for the stock market, up 3%, ITOT, iShares, Core, S&P Total US Stock Market. The benchmark VBINX up 1.6, and that by default makes government bonds the weakest or one of the weaker asset classes at minus 60 basis points. The rotation of the week shows not much difference. Look at the tails for ITOT and GOV, they're really short, so they're not big moves. There's not a big momentum move there. The biggest momentum is in real estate and in commodities. Nevertheless, you will still see a pretty good performance for both asset classes despite the weak rotation on the daily with big tails, but the bigger picture is still pretty strong, so we remain firm on real estate and commodities going forward. Here is the longer term picture for the asset classes. We still see commodities still doing pretty good. We see real estate coming down, but it's really high reading on the RS ratio scale, and the negative rotation or the weaker rotation for stocks continues. We're still pointing at a negative RRG heading, so we're inside weakening, but we're moving at a negative RRG heading. That's a heading between 180 and 270 degrees if you look at a compass, and government bonds are going the other way. In terms of relative strength, the trends are still in favor of stocks over bonds, but they are weakening, and the question is whether that weakness will continue or whether we will see a rotation of stocks going back up north into leading and government bonds the other way. It's too early to tell right now, but it's something that I keep in the back of my mind. And there are actually two charts that I want to share with you, and it's gonna cost the overview of sectors, but that's okay because we're gonna look at a lot of sectors in the seasonality part. Me, you, I, a lot of commentators, a lot of people always look at the S&P, and that's good. There's no problem with that. I've showed this S&P chart a number of times, and I brought it up when I was a guest at Dave Keller's The Final Bar last week, and I pointed out the negative divergence that is building up in the S&P chart, and it's still continuing. It's still there, despite the fact that the S&P is making new highs. Yes, they're new highs, but are they really new highs? Is it a really firm, clear breakthrough? I doubt it. I see the market itching higher, but it is itching. It's like, yeah, we're higher, but it's not. There's not real power behind it, and that's indicated by this negative divergence in that RSI that's continuing to build up. That's continuing to build pressure. And when that moves, it means that usually moves to the downside in terms of price. And with a little fantasy, mark my words, with a little fantasy, you can see a rising wedge pattern building up. Now, I will be the first one to admit that lines that have only 2 touch points are very debatable. So I made them very light, and I'm just penciling them in as a potential pattern. Not saying that it's happening, but the combination of this itching higher and that negative divergence makes me really careful with the S&P. And then I looked at the Dow, and what you see there is that the Dow is already in a downtrend. If you define a downtrend as lower highs and lower lows, now mind you, this is a daily chart of the Dow. This was a weekly chart of the S&P. It's a daily chart of the Dow. You see a high, you see a lower high, potentially a new lower high. You see a low, you see a lower low, and you see a new lower low. That is rolling over. That market is rolling over. If you put that on a weekly scale, you will see it even better. You will see it rolling over. You see it moving. You see the negative divergence here. And you see it with a lot more indexes, broader market indexes. This is large cap. So I'm really, really concerned about the short-term outlook for the stock market, especially for SPY, Dow, etc. If we go to the sectors really, really quickly, looking at last week's rotation, including today, we see that it has been pretty much a offensive risk-on rotation, led by communication services, discretionary, technology, and even financials. And the risk-off, more defensives, have been underperforming the S&P 500. If we look at the longer-term picture on the right, then I'm still concerned about discretionary and tech inside the lagging quadrant. Despite the strength that we've seen over the last few weeks, this position is really still worrisome. But as I explained last week, it's a mixed bag. Look at utilities, look at staples, look at healthcare. They're all rolling over, inside improving. So it's still very hard to read. There is no clear risk on or risk off in terms of sector rotation. There's no clear sector rotation going on. Good stuff for communication services and energy and real estate. And we'll look at the seasonal factors that are going to come into that in the next segment. And it's the last Tuesday of the month, and the regulars know that that means that we will be taking a look at seasonality. And I've always been using this 3D spreadsheet showing some data on seasonality. The image that we're looking at right now is the percentage of months that a sector is outperforming the S&P 500 or SPY. And I'm looking for really high or really low numbers. So really high numbers are interesting because that means that over the last 20 years, that's the data span that we're looking at, that sector outperformed the S&P 500. So high numbers are, I don't know, 65, 70 plus, etc. 50% means a coin toss. That's like flipping a coin, doesn't really matter, 50% up or down. So when it becomes 65 and higher, 70%, then I become really interesting. When it goes to 35, 30, etc., then I'm also interested because that means that the sector has pretty consistently underperforming the S&P in that month. So where are we now? The string of bars that you see here is for the month of July. That's the coming month. And a few months ago, I have to say, I started looking a few months ahead because I believe that, you know, these monthly data are monthly snapshots, and the market doesn't really like behave per month. So I started looking ahead a little bit, and I'll tell you a little bit more about the project that I'm working on in relation to seasonality later on. But let's have a look at the current situation in seasonality. I've highlighted a few areas and a few numbers. Let's start with communication services. So 67%, almost 70% of the months of July, communication services has been outperforming the S&P 500. That's definitely an interesting sector to watch in the coming month. Now, if we look ahead, then there's an interesting string because 67, 25, 67. So it looks as if we're going into a good month, then we will have a very weak month, and then we will go into a good month again, and sort of going towards the end of the year. Let's see how that works out. We're going to look at the RRG and the actual rotation as well, because the whole goal of this exercise is to see if we can find historical data on outperformance and average performance for that month, and if we can align that with the rotation, the current rotation that we see on the RRG. On energy, I have highlighted here 45%, that's pretty much because of the low expected average return, which we will look at in a minute. But you know, the 45, I explicitly didn't make a red border around it because 45 is very close to 50. It doesn't really matter, but the average performance here on energy is very weak. Now technology, 60, 65, usually not really a number that I'm very excited about. That's why the border is light green. It's a little bit shaded, but the expected performance is pretty good. So that makes it an interesting sector to watch. Now, probably the best and the strongest sector going into July and well, at least in August, is real estate. 72% of the month in history, real estate has been outperforming the S&P 500 by a pretty decent number, as we will see. And also August looks pretty good, and then we taper off into September, October, and November. So, as you know, real estate is already on a good move, a good trail right now. Was like that in June already. So it looks as if we will get a bit of follow through in that real estate performance, in that real estate rally on a relative basis going forward in July and August. And then utilities, I've also shaded red for the same reason as I did that with energy, because you know, 45% and also healthcare 45%. It's not super big and super strong, but the expected performance for utilities was also very weak. And we will look at the expected performance for all the sectors here going into July. And then we'll see that for communication services, we're expecting 0.5% outperformance in July, followed by 20 bips underperformance in August, and then another 50 basis points outperformance in September. Now, here you see why I shaded energy red on the prior sheet, because the average performance for energy, for the sector of energy in July is minus 1.4, and then in August we'll have minus 0.7. So despite the fact that the percentage of months that is outperforming, or in this case, you know, 55% of underperformance, is not very significant, I think that the average performance is something to take into account, because those are not very strong numbers. If we look at real estate, then you see that here 1.7, 1.6%, while the numbers are strong, so 72%, 61%, with an expected performance or an average performance historically of 1.7 and 1.6%, that makes it a really interesting sector to watch from a long perspective, of course, going into July. And again, here utilities, I shaded the 45. Again, the 45 is not super significant, but I think that the minus 1.1% for the utility sector on average in the month of July is something that we probably may need to keep an eye on, because there could be a little bit of a surprise there. Now, I've been doing this setup with those charts for quite a while now, and everybody who wants to have that spreadsheet is welcome to drop me an email, and I'll be happy to share it with you. A lot of you have already received it. If there are any updates, if I update the data, you will get an update. But you always need to see if you can improve things. And what I did in the last few, I think I've been 2 months, 10 weeks maybe, I've been working with a Tableau specialist in Scotland. Greek guy named Thanasis, great guy, super versed in Tableau and putting data into visualizations. And it's work in progress, but I think we're at the stage where I can share with you what we've come up with. So here is the visualization of the same data set as we've been looking at in the spreadsheet, but visualized a little different. Let me blow this up to start with before we start putting it in context with the RRG. Blow it up here. We got everything on the screen. So we're looking at the sectors as we've been doing, but here we have the historical number of months outperforming or underperforming and the expected return or the average return in one graph. Now let me explain that to you. The thickness of the line is the number of months or the percentage of months that a sector has been outperforming the S&P 500. So if you look at materials here, these percentages are the percentages from the Excel sheet. So 50%, 50%, 40. If we look at communication services, that is 54% in June, and we're going to 69. That's the number that we had. And there, let me, I already see what I did wrong. I can actually much better do it like that. And now we are looking July, August, September. So now we have the same numbers as we had on the sheet. So 69, and then we have real estate here at 68. But now the historical performance is the color code. So very dark red is minus 3%. That I don't think we ever reached that. It's an average, of course. There may be some individual months where it happened, but on average we never reached that minus 3, and we also never reached a plus 3, which is the very dark green. So how do you read this? We're looking for fat lines. That means a high number of outperformance, and dark green. So the fat dark green is ideal. That means that there is a high percentage of months of outperformance and the average performance is really, really strong. Or we're looking for thin dark reds. So the thinner the line, like here, financials, then you can see in the dialog that it is 30% of the months between 2002 and 2021, financials outperformed. So 70% of the months it underperformed, and it was an average performance of minus 50 basis points. So if we go back to the reality, to the current selection, then we hover over communication services, and we see that in July, 69% of the months outperformed with an average of 60 basis points. Now that is interesting information, and I now have it all in one sheet or in one graph, in one visualization. And here you can also see, I highlighted the energy at 45. You see that it is not, it's very close to 50%, but it's a dark red. And that's also something of a warning signal. Also here, technology, interesting sector, of course, 60 and 65%, not exciting from a perspective of the number of months historically that it's been outperforming. But it's been outperforming here with 20 bips 60% of the time, and here with 40 bips. So we had above 50, 60, 65%, and on average an outperformance of the S&P 500. And here we have real estate, and you see here it's a much darker green than we saw on technology. And you can see here that real estate on average in July outperformed the S&P 1.5%, and that happened almost 70% of the months. And here you see the same for utilities. The 45% is not a very significant number, but the minus 1.2% is something to take into account. So the utilities minus 1.2 and the dark red here on energy minus 1.8, those are things that I'd like to keep an eye on. And then we have discretionary, also a very important sector, 10% of outperformance at 60% of the months, and here we have 40% of outperformance, 55% of the months. Now, let's bring this one back to the left, and now we can compare it with the actual rotations here on the right. So which sectors did we identify? Starting with communication services. So communication services, as you can see and as you know, been doing pretty well actually. So we rotated from leading through weakening, and now we're, need to keep my control button. So, and now we're back into leading. And that, I think that aligns and coincides with the strength that we see in seasonality, about 70%, and we're going to expect an average performance of 60 basis points over SPY. So communication services is definitely a sector that you want to keep an eye on going into July. Now, the second one from a positive point of view is real estate. 68% of the months, and you can see that real estate's already been doing really, really well. And you can also see that here in this chart, where you can see that starting from May, June, it was above 50%, and we had a outperformance of 1% here on average, 60%, and now we're going to expect another 1.5% going into July. So real estate together with communication services are the sectors that I would like to keep an eye on from a seasonal perspective going into July. I need to do it like that. So which ones now? Technology is kind of difficult. We saw that it's above, but you can see that the actual rotation is not super strong yet. So I'll still be pretty careful with the technology sector. Similar thing with consumer discretionary. That's actually pointing further into the lagging quadrant. The number of months outperforming is only 10% over 50, so 60, and the average performance is only 10 basis points over SPY, and going into August it's 40 basis points over SPY. So we're going to take a look and review discretionary in a month's time. The other sectors that I wanted to take a deeper look at is healthcare. That was the pick for June, and if we look at the performance of healthcare, then we can see that over the last 5 weeks, healthcare performed 2.3, and that is slightly over SPY. So it lived up to the expectations, but only just. It wasn't fantastic. And what you can see here is that, and that's the reason why I'm working on a system to make this more granular. So be on the lookout for a chart like this or the spreadsheet format, but I think we're going to stick with this one, which will show you more data points. So not only 12 data points per year, but weekly and maybe up to daily, and we will make that seasonal pattern more gradual and slower, and not have it only spike into 1 month or 1 month performance. Because I really do think that, for example, the seasonality for healthcare started to pick up here, had a really good string, March, April, May, and maybe the peak. So we expected the peak to be in June. I wouldn't be surprised if we have more data and if we have more granular data that we will see the peak maybe somewhere at the end of May, at the start of June, and then leveling off and rolling over. And what you see here is on the RRG that the healthcare sector seems to have broken off its positive rotation, and it's now rolling over inside the improving quadrant, and we all know that that is usually not a very good sign. So healthcare rolling over inside improving with a seasonal pattern pointing to an underperformance in the month of July, and the average performance is flat. It's 0.0%. So that is like flat. Nothing happens. So that's the picture for healthcare going into July. And then utilities and energy, as you know, the percentage of months outperforming or underperforming is very close to 50%. So not super exciting here. But it is especially the minus 1.8 on the energy sector that is definitely worth watching. The only problem is that the tail on energy is actually really, really good. So here we do not have an alignment of the current rotation and the expected seasonality. So here we have a clash of seasonality and current rotation. And for utilities, that is different. Here we do have at least some sort of an alignment, because just like healthcare, utility is already leading the way, a little bit further ahead than healthcare. Insight improving, rolling over, and already at a negative heading, pointing towards the lagging quadrant. And according to seasonality, marginally below 50%, but an average performance in July of minus 1.2%. And if this continues, then that would not surprise me if utilities as a sector underperform the S&P 500 going into the month or in the month of July, I have to say. Finally, a quick look at the seasonality for the S&P 500 itself, and you can see that July, on average, 68%, so almost 70% of the months of July, the S&P 500 closed higher than it opened. So this is an absolute seasonality chart. 68% of the months of July, the S&P 500 showed a higher close than it opened the month, and the average performance is, or was, 1.3%. And that, as you may have heard in my overview, clashes with my view on the S&P 500. It's probably going to keep the S&P 500 from a real drop. So this seasonal pattern for the S&P 500 is probably gonna level off and maybe be some sort of counterweight to the negative chart, the negative environment that I currently still see for the S&P 500, and what urges me to remain very, very cautious for the market at this point in time. One more thing that I wanted to share with you is the fact that I will be a speaker at the CMT Association's European Summit 2021 event, which will take place this week, actually, on Thursday and Friday, July 1st and 2nd. My talk is scheduled now for the opening speech on July 2nd. And there is a whole heap of very well-known and good speakers that I certainly respect. And if you look at the list, then you will certainly recognize probably some other people that are also present here on StockCharts television. JC Perez, one of them, who doesn't know him. Katie Stockton, regular guest at the final bar. Yours truly. And then if you're in the CMT Association, you might know a few of the other speakers as well. Just go to the cmtassociation.org page and register yourself if you are a CMT member. If you're a CMTA member, attendance is free. If you are not, they require a small fee, but you will have access to all talks on 2 days. They will start at 10 a.m. GMT, so be careful with that. And if you're looking for more information, if you're looking for a number of interesting talks, please tune in, and I hope to see you at the European Summit 2021. My talk on Friday, July the 2nd, 10 a.m. GMT. Hope to see you there. And this concludes Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you back next week, same time, same place, same show.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.